that one song
You
about.
can't not
That is.
say it.
Requested, yeah.
Okay, well, welcome to Wealth Building. Today, everybody, let me just get my screen right. Okay. So today, we're going to be talking about an important topic, which is year-end tax planning. And, you know, we all like to build wealth, right? But one of the goals is keeping our wealth, is keeping the wealth that we've built. So tax planning becomes a really important thing. And I was listening to a CPA on a KW wealth call last week in that mastermind group, and a lot of which some of the things that she was talking about is what I'm going to share with you today. But she said, you know, some people are very, very afraid of taxes and feel that taxes are going to take something away from them. And so she said, you have to approach it with a different mindset, in that unless the tax law says that you can't do something, you can. So, you know, that's an interesting change because it's very specific as to what the tax law will and will not let you do. So you just have to make sure that you are using a professional that really does know what the tax law can do. And especially for real estate professionals. And we'll talk.
I think you got muted somehow.
To unmute. Okay. So we're going to talk about real estate professionals because real estate professionals is a very special classification that allows us as real estate professionals to have the ability to deduct a lot of things that others cannot. So especially when it comes to investments in real estate. So we'll talk about that as we go through today. So the number one thing, if you have not done it yet, is you should schedule a meeting with your accountant or CPA. And that said, I want you to know that I am not an accountant or CPA, and I am going to give you the disclaimer that I don't play one on TV. And anything that I tell you today should absolutely be checked with your professional and how it applies to you and your ability to use it when filing your own personal and business taxes. So I just want to make sure I'm giving you ideas, I'm giving you things that I know about, but they need to be double checked with a professional before you do anything with them. So, you know, the first thing when you sit down with your accountant is as independent contractors, we all need to see and know if we are up to date on our estimated payments, right? So we have a date coming up on September 15th. The third quarter estimates are due. So it's a great time now for you to sit with your accountant and project out the rest of the year. And so we need to know what we have done in income up until now and what our projections are going forward. And so when we ask you for your commissions and command, I'm just going to give you this plug. It's so we know our income going forward. So it's really important not only to us, but it's important to you too, because you have to be able to sit down with your accountant and say, okay, this is what I'm projecting out. And a scary thought is that somebody said to me, well, you know, there's only 85 more days, and this was a few days ago, left to write business for this year. Okay, because that takes us up to about November 1st. And let's face it, folks, if we don't have something under contract by November 1st, it's probably not closing in the year 2023. So that was kind of it. Let me see some hands raised if that's an unbelievable thought to you, and you never even actually thought of that, right? People think you're like, oh, we have 5 months left in the year. No, in our business, we have less than 3 months to write the business that we want to see close this year. So you should have a pretty good handle on what you're going to be able to project out for the balance of the year, and make sure you get up to date on the tax payments. And if there's one area that I can say over the years that I have seen many agents get in trouble with, it's this. It's failing to set aside at least 25 to 35% of your income every time you get a commission check into that tax account, and then making sure that you pay your estimates on time. I've seen people make in excess of $500,000 and be owing the government a lot of money, and be coming and asking for draws on their commission and things like that because they had no money. So I don't want to see anybody get into that. So you have to make sure you're up to date on your estimates. You also want to get a handle on your expenses for the year. And I'm just going to talk about a few different areas, that you want to make sure for business expenses, as real estate professionals that we can look at. So before I actually go into the expenses, so let's talk about real estate professional. Okay. Being able to claim on your taxes that you are a real estate professional does not necessarily meet the threshold of just having a license. Okay, you have to be able to prove to the IRS that you are working a specific number of hours, and there's like a seven criteria that you have to meet in order to do that. Okay, most of the time, if you are working full-time in real estate, you are meeting that threshold. Sometimes if you are working part-time, you will also meet that threshold. But you want to make sure you review that with your accountant, and that you can get that classification real estate professional. Because what that allows you to do is, if you have investments in real estate that you own and control, and you have losses in there, okay, you do not have to declare them as passive losses. You can declare them against your income. Okay, so there's a very fine distinction in there, and you can get into active versus passive. Even if you're investing in real estate syndicates, okay, there is a way to declare anything, like if there is accelerated depreciation or something like that in that syndicate, you would be able to take those deductions against your ordinary income. And again, that could be very, very beneficial in reducing, because that's what we always want to do, is we want to reduce whatever we're getting in income, offset it with expenses, or losses. Sometimes, if you're doing this for a while, and in real estate income, sometimes you could have a property that makes money, but because of depreciation, you could show a loss. And that's a beautiful thing. And so that loss would go against your ordinary income. So that's an important classification to determine with your accountant. So as a real estate professional, we have a lot of business deductions that we can take. And I'm just going to talk about a few of them. This way you're making sure you can definitely declare home office, and you'll have to discuss with your accountant and how you do that. If you haven't, even if you have an office in the office, you probably can still do it. You're going to take a percentage. There's a couple of different ways. You can take a flat deduction, or you can do it where you're taking a percentage based on the office's area as a total of your whole home, taking a percentage of the mortgage, a percentage of your electric, and blah, blah, blah. So you'll want to talk about home office. You also want to make sure that you're deducting for your auto. And again, keeping really great journals and notes on these things will be the best way for you if you ever get audited. So keeping, and again, an important part of that is your calendar, right? It is making sure that your calendar shows what you're doing. Again, when you're making the claim of real estate professional, it will help if you have a calendar that shows clearly that so many hours out of every week have been dedicated to that. Same thing with mileage. If you have where you've gone and you can calculate the approximate mileage from there, 69 cents per mile is now the deduction that the IRS will allow. So you can take a mileage deduction, you can deduct for repairs, tires, all sorts of things, auto insurance. And again, it may be a partial. Okay, if you only have one car and you're using it some of the time for personal use and some of the time for business use. Also, this is a great year to potentially buy a vehicle or buy equipment. So there was some special tax laws in effect that are sunsetting. Up until last year, it was 100% deduction you could take on office equipment and things like that, like automobiles, office equipment. You could deduct up to 1.1 million in acquisitions, 100%. This year, it's 80%. So if you buy a computer, a phone, a printer, anything like that for your business, you can deduct it 100%. Now on vehicle, I'm sorry, 80% this year. And what's going to happen is next year it's going to be 60%. The next year it's going to be 40%. So you're better off to do it this year. If you haven't done it already last year, you're better off to do it this year before the end of the year so you can take advantage of 80% deduction. On vehicles, if you purchase a vehicle this year, and the vehicle does not weigh over 6,000 pounds, so basically it's not a truck, pretty much any cars or SUVs, you can deduct 10,200 for that vehicle plus bonus depreciation of $8,000. Okay, so you can deduct up to $18,000 on a regular auto purchase. If it's a truck and it weighs over 6,000 pounds gross weight and up to 14,000 pounds gross weight, which is most of like your Ram trucks. Actually, I'm buying my truck this year. And you know what? I'm going to be able to deduct it 100% because it's over 6,000 pounds. And you can do that with the trucks. So now is a good time. The other thing I just want to tell you as a note is a lot of car leases are coming up that were leased in 2019 and 2020. Okay. Those cars have very low residuals. We all know in the meantime what has happened with the value of used cars. They've gone up significantly. So like my husband and I are both looking at our leases. We've looked at some other leases, and in every case, there's a significant gap between the buyout on that lease and what the car is actually worth. And even if you don't want to keep it, I don't know if Kristen Pilati is on this call, but she did it. She actually got a third party to buy the car from her and made like $5,000 because her lease payout was $5,000 less. So it's a great time now, right? So you're going to make some money on that, but then you're going to be able to take the bonus deduction this year of $8,000. So it's a really smart time. I don't usually like buying cars. Like anybody who knows me knows I'm always leasing cars because I can take the full deduction every year on the taxes for a lease payment. But I'm going to tell you that right now, especially because cars are at such a premium and it's even so difficult to buy new cars, if you have a car with low mileage and you have this scenario, you might want to certainly consider buying that vehicle as opposed to turning it back in on a lease. So, okay. Who has kids under the age of 18? Okay. So there's something really neat you can do with your kids. They can work in your business, okay? And they can earn up to it's between $13,000 and $14,000 this year. So if you put them next to a for sale sign, okay, on a social media post, they are a model for you. They're talent. They get paid whatever the going rate is for talent. Okay. You can take that money. Okay. You're going to now deduct that $13,000 or $14,000 off of your income. You're going to put it in an account in your child's name. You're going to have a debit card for that child. You're going to pay for their sports, their tutoring, everything that they need. And they're paying for it, but it is tax deductible from your business. Okay, but you have to, again, you have to have some backup for this, right? You have to be, having them on your social media posts. You have to have an invoice from them to your company, for a certain amount of money, and then you're gonna pay them, and so that's a neat little trick with kids. And I did not know this was allowed when my kids were younger, and now darn it, they're too old. So I can't do it. Ladies, I'll address this mostly to you. There is a reasonable amount that you can deduct for your uniform that you wear to work. Okay, so I see Diane Doyle laughing at this over there. So yeah, so again, check with your accountant, but if you have some of your Chico's receipts and things like that, and you have again some social media posts where you're wearing your nice clothing that you have to wear. Certainly if you're buying any Keller Williams t-shirts or things like that, all of this can be deductible under your business. And I hope that everybody has their business under an LLC. We've talked about this a lot of times, but there is risk management, liability protection in doing that. And also, I'm just going to tell you, one of my longtime accountants told me, listen, if you're making, over $100,000, you're a high earner in this country. So you have a higher chance of getting audited. When you're an LLC and you're earning over $100,000 in this country, you're a small fish in a big pond. So you probably have less of a chance on audit too. So just something to think about. But again, it's really more for the shielding and protection of liability, and again, the tax implications. So one thing that I'm not real familiar with, I do have one, but you may want to look into it, is having an HSA. And I am going to get somebody to come in on one of these wealth sessions and talk about this. So that's a health savings account. And that is, if you have high deductible insurance, you are allowed to put, I believe it's about up to $7,000 per person, for like a $7,000 each for a husband and wife, into your HSA. That is deductible from your business. And the neat part about it, and where it really comes into play, is not even so much the tax deductibility, but it's that there are a lot of different vehicles, not unlike an IRA, that you can take that HSA money and invest it. You can do like a self-directed HSA and put it in T-bills, put it in different things, and it's growing. And because that was tax-free money, the growth on it is tax-free too. So you can get some nice compounding there of your money. And the other nice thing about that is that there's no minimum distributions that you have to make out of it. So that can stay in for a long time as tax-free and growing. Okay, SEP and IRA. We have talked about this before. A great way to not only save money for your retirement, but also to invest money is to do a self-directed IRA. So you may have an IRA right now that is sitting in a brokerage account or in a bank or something. You can go to companies like Horizon Trust, Rocket. Is it Rocket Dollar IRA, Anna? Is that what it is? Yes, Rocket Dollar IRA. And that money can go in there, and then you can direct where that money goes. It can go into real estate syndication investments. It can go into T-bills. It can go into a lot of different things. And again, that is all, any growth on that is tax deferred. So it won't come until you start to take the money out, with the thought being that that will be when you're later in life, when you're in a lower tax bracket. And another thing that you may want to consider is the Roth IRAs, where you're paying the tax, but you're getting that money into an IRA. And from the time you put it in, it is now tax free, and the growth is tax free going into the future. And I don't believe there's a minimum distribution on a Roth either. So that can grow into a pretty long time. And a lot of times if you need to do something with the money on there, those are great products, those types of IRAs, to be able to borrow against to do investments. So you leave the money sitting in there tax free or tax deferred, and then you borrow against it to actually do the investment at a lower cost. And again, we can talk about that in more detail another time. Okay, then we have, and we've talked about this on a previous one, I think earlier in the year, for those of you who might not be on, the Augusta rule. And so the Augusta rule is called such because it started in Augusta, Georgia, where they have the Masters. And there are a lot of rich folks there who have, I guess, a lot of pull in Congress and with the IRS. And they wanted to rent their homes out for the 2 weeks that the Masters tournament is there every year. And they did not want to have to claim this income. And guess what? They got it into law. So now, if you have a business, if you have an LLC and you decide to have a client event at your home, okay, not only can you deduct the cost of the food and the beverage and everything like that, well, you can go down to the hotel that's nearest to you and you can ask them what it would cost to rent a room there to have an event. Whatever it costs there, you have that record and you bill yourself. Okay, your LLC bills you personally. Okay, so your LLC is going to, let's just say it's $2,000. Your LLC is going to write down the $2,000 as an expense, and you're going to get that $2,000 and you're not going to have to claim it as income. You can do this for up to 14 days, and it could be different days in the year. With your personal residence and not claim the income from that. And you'll take the tax deduction from your business. Okay. And we're going to go to comments, I think, later, because I see lots of things going into the comments, into the chat here. Okay. Energy tax credits. There is a lot out there right now in the IRS with energy tax credits. Number one is if you have a car that's an electric vehicle, you should definitely talk to your accountant about what tax credits are available for that. Also, there is a tax law. It is 45L. It deals with home energy tax credits. And especially if you have a rental property, you want to look at this law because there are some pretty easy things you can do to your rental property that would probably improve the value of the property, and you're going to get a nice tax deduction on it. So energy tax credits, the government is pushing, the electric. So they are definitely giving some credits there on cars and homes. How many topics for those whoever's typing in there? How many did we get to? We got to 10. Okay, that was my goal for today. And I just had so many different like notes scratched out here. Does anybody have questions or is somebody monitoring the chat here? Is there anything questions in the chat?
No specific questions in the chat. I think
I see Madeline has her hand up.
Yeah, am I muted? Let me see.
Nope, you're on now.
Oh, okay. Hi.
Hey,
Okay,
Jenny.
so you lost me. You were talking about
Oh.
the hotel. You were talking about doing the deduction for the hotel, and
Okay.
I got
Okay.
that. But then you said in the next
All
breath,
right.
you said
Let
something
me,
about somebody else talking.
Yeah, I just muted them.
Okay. But then you said something about, the Augusta rule and your home. So I'm kind of
Oh,
confused.
sorry. Yeah, I know
got
I went through
jumped in the other and I kind of got
Yeah.
lost. So
So basically you're using a local hotel to establish the value of the cost of using your home. Okay, so if they have a meeting room or an outdoor area or something like that,
okay.
right, so you need to always have the backup to prove to the IRS, okay, well, I know that this is the value because I went down here to the Ritz-Carlton and, this is what they're charging per day. So this is now what I'm charging for my company for my house. And again, so that's how you're just using a hotel, or
Okay.
it could be some other venue where you could rent a room or rent space, or restaurants even, what would they charge you to do that, so that you're establishing the value of a fair market value of what you're charging your company to rent out your house.
So you're saying if you do a client event or other things at your home, you're using that to get the cost basis of what you're going to be deducting. But then did you also say that you could do it up to like 2 weeks? Was that the rule?
Right. So you can rent your house to your company for up to 2 weeks. So,
Right.
and again, it could be, a day in January, 3 days in March, if you have to have a board meeting, you could do that in your house. And again, if you're having a client event or something, you're going to just want to make sure that you have some pictures of the client events and, yeah.
Okay, thanks.
Can I add something to that?
Sure, Matt.
So my accountant had me start doing the Augusta rule about 2 years ago. And what he did was gave me a lease agreement to fill out between the owners of my house, myself and my wife, and my LLC. So I
Right.
have a document, right, that we
Yep,
all
you have to
sign
have
off
that
on and
document too.
keep that. And he basically said, so he had me, I called like 5 conference places around the area. And I said, I need to rent a room for like 10 people with catering for, half a day. What is it going to cost? And I got rates between like $800 and $2,000 for the day. And he said to me, he says, yeah, like 1,500, that's a good average. He goes, that's just fine for your area, for the New York area. And I'm like, so I can have 14 meetings where I can then pay myself $18,000. And he's like, yeah, absolutely. He said, the important things are have minutes for your meetings. Right. So like if you do a monthly LLC meeting with your board of advisors, have minutes and do an actual money transfer. He says the IRS wants to see the
Oh,
money.
yes, yes,
So
that's a
it
great
can't just
point.
be right. It can't just be a paper. Oh, I'm I'm billing myself, and then he says you need to have the actual money movement. So
So what
Yes.
are you saying about that? Are you saying that you actually take it from one account and move it to the other
Yes.
account?
yeah. So
Okay.
I generate a bill from
Mhm.
it goes from myself. I'm billing my LLC for holding the meeting, and then I pay my LLC, pay that invoice, and I'm paying that to myself, right? So it's going from my business account. I'm paying the bill to my personal account. So you get the write off on the LLC and tax-free income to
Yeah,
yourself.
Matt, and you know what? You have 3 young kids too, so you could get almost 40 grand out of those
It's
kids.
well, it
You
is. It's
shouldn't even
great.
be paying taxes.
I know. I know. Well, so to touch on that, if I can, my accountant had me do what's called a family management company, which
Oh,
is it's another little. So it's basically a sole proprietorship. So I registered a sole proprietorship that I own. Opened up a bank account, right? So I went to the clerk's office. I registered a business, sole proprietorship. Used that to open up a bank account. You can create so basically the kids work for the family management company. So the family management company bills the LLC for the kids for their hours, for their work for you. You pay the family management company from your LLC, and then the family management company distributes the money into the bank accounts that you're a custodian on for your children. The
Right.
downside to that is it's unearned income. So you can't put it into a Roth. You can't use it to open up a Roth account for them and for other, there's other benefits that you lose out on, but there's additional tax benefits. And
Right, but you can just use it to pay things that normally you would be taking, taxed money to pay for.
Yeah, exactly. Because the money's sitting in their bank account that you have also control over as they're under the age of 18. So
Right. Yeah. Yeah. And you can turn around and, even though you can't put it in a Roth for them, it frees up that much, conceivably, less taxed income where you can put it in your Roth. So
right. Because the way he explained it to me is like, you don't want to 1099 them, you don't want a W-2, he's like, this is the way to do it, but here's the downsides to doing it.
Great.
Anyway.
And I believe you could do that with any kids under the age of 18, even grandkids too, Madeline.
Wait, what? Grandkids too?
Yes.
Oh, okay, that's interesting. I just wanted to throw out there, what Matt just said made me think of something that my accountant has worked with me on is, and some of you might be doing this already, but I was a little bit messy. It was just streamlining how the money is flowing, and so that he can get in and see my bank accounts and be able to make sure he's not missing a deduction, right? So when you're using different credit cards because you want, miles, or you want points, or you're moving money around, just make sure that you're keeping track of everything. And even though, for me, I really don't want to have to, back long ago, I used to do the box of receipts, right? But nobody wants to do that anymore. So just, keep track of where all your money's flowing and make sure your accountant can see it, because there may be things that you can deduct that you're not sharing with him, or her, and this way they can see it for themselves.
Yeah, that's a great point, to streamline things, because let me tell you, when you start adding LLCs, okay, especially like if you get into buying properties or things like that, I'm in a really painful process right now, because, I have been told that when you file a tax return and you have, 17 LLCs, that again, that's another red flag. So now we are in the process of putting everything into one holding company. So you may want to think about that, which is a little similar to what Matt was saying. You have a holding company that is overarching, to all of, all of the other LLCs. And the only other thing is that I could say is, think big. And when you're thinking big, do your estate plan early, because that's another thing that becomes very difficult to do if you wait. So.
Yeah, that's another thing I did this year too, was all of the different investments I have all now are under one LLC. And so that, like what Rosemarie just said, but then also just, like I said, the way the money flows, even how you spend the money, right? Just try to keep it in one account if you can, or one account, one credit card, so that you can also track your expenses more easily too.
Are there any questions in the chat, Rita?
Diana asked if these are deductions that new agents can use as well.
Well, yeah, I mean, if you're brand new to the business, any of your startup costs, you can deduct all of your startup costs, your formation of your LLC, any tax and accounting, that you had to do that. Anything you had to purchase, any equipment or anything you had to purchase for the business, all of that is tax deductible.
I think that was the only question actually listed in the chat.
Okay. Anybody else with any questions or thoughts that they would like to share? Okay, well.
Wait, before you go, so
Yeah.
just speaking,
I have a couple of things too.
Just speaking of planning, we want to talk about next month's topic, right? So Rosemarie does these classes every month on Thursdays, the third Thursday usually of the month at 2 p.m. And every month we're going to cover a different wealth building topic. So talking about estate planning, right? Next month's topic is using a life insurance policy as an investment vehicle. And we're going to have a guest speaker on. Rosemarie has a guest speaker lined up that will come on and talk to you about how you can use a life insurance policy to the funds to reinvest.
Yes, and I think in October we're going to talk about flipping, and we're going to have I think one of even our local KW agents who is a flipper is going to come on with us and talk to us about that. And I'm also hoping that by November we're going to know more about Gary Keller's Opportunity Fund. Hopefully everybody saw the post on that this week. Actually very exciting that Gary has created an investment vehicle and is allowing us all to potentially invest alongside him in real estate, him and Brett Tanner, two of the smartest guys in real estate for sure in my book. So we will be talking more as we get information about Gary's Opportunity Fund. And we're also going to talk about buying discounted notes. This is an area that I personally started getting involved in this year, and we're going to have some good information on that and your ability to do that. So lots of good stuff coming up. Hopefully you all found this valuable today, and you're going to go out and make an appointment with your accountant if you haven't done so already.
Thank
Okay.
you.
Thank you
Thanks,
so
everyone.
much.
Thanks, Rosemarie.
Thank you.